Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, May 15th, 2025. Here's what I'll do, and I'll try to keep it in this order. That way you can skip ahead if you want to go to a certain particular section. I'll just start out with a semi-brief update on the equity markets. We're just going to look at the charts real quick, and then some related things, such as a couple different indicators. We'll look at my put-to-call, equity-only put-to-call ratio, the VIX, and the VXY, the VIX ETN. That's mostly it. And then again, on a somewhat related, very related note, the SOXX semiconductor index ETF, NVDA, which is a big component of that, of course, big 800-pound gorilla in the room for the chip sector. Okay, so that'll kind of conclude the equity markets and related instruments. Brief updates on gold, GDX, and the US dollar, and then time permitting, I'll get to some of the commodities I want to do updates on. I would like to do an update on wheat for sure, if I can get to that. Nat gas, we have a trade that's just pretty much just hit our third target where I'm probably going to call that trade in. I'll get to that in a second. Make that the final target. And then our VIXY. I'm just looking at my notepad. I already got that. Going to have that up front. All right, starting out here, this is QQQ. To recap and reiterate, especially anybody new, my trading plan has not changed or deviated at all. My plan was and remains, after going long here, covering all shorts, going to a full long bias at that point, go up to and then start closing longs out there, which I did a couple. We've had trades, the initial pop that was made it clear to sell there, pull back. We had another push up, and then this was my scale in zone, with the plan being to scale in up to but not above the 200-day simple moving average. That's the blue line there, which we tested for a couple days, then we took it out, and then my plan plan B, the scale out portion, started above this with a scale out 2 days ago, a quarter position. And my plan as of now, yesterday we were pretty much flat. Today we're pretty much flat. You can see right now QQQ is 0.06. I know yesterday I was watching, there was a pretty stark underperformance between the equal weighted indexes. That's the S&P 500 equal weight and the Nasdaq 100 equal weight. Be honest, I haven't even looked today. Let's do that. You can just quickly look by QQQE. That's actually outperforming a hair today. But for the most part, the indexes are flat. And so being that we spiked above yesterday's high, that is now the next lot, and I'm actually going to go ahead and do, at this point, instead of another quarter, I'll do half. So again, to reiterate, all along it was never and wouldn't be and still isn't a full position. So it was only a partial position, awaiting the next sell signal or objective entry on a break of this uptrend line off the lows in both QQQ, SPY, and there's several leading sectors and leading stocks that I've covered in recent videos. So I think we had a break on the financials, a slight break below, but again, we need to see at least the majority or at least a handful. And again, you put a higher weighting on QQQ and SPY, you put a higher weighting on XLK, the tech sector, than you do on XLI, the industrials, just due to the weighting in the indexes. So so that's it. So I'm scaling out of what isn't even a full position, scaled out one quarter lot, and I'll take another half out at minimum if we take out those recent highs. In fact, I have set stop loss orders on my futures, my NQs, good to cancel round the clock should that happen today, overnight, or anytime there. So I like to see, I see that nice little, nothing big, but a little reversal, slight pop above. You can see the markets, the momentum is starting to wane. We've had that pop above and back into the trading range. Now, and again, this is to reiterate what I've said back before it happened, that if we do go above 500, and if we do go above the 200-day moving averages, that in itself, both those, which were one and the same, that was the candle that took out the 200 days and the bottom of this multi-month trading range, that topping pattern, instantly when that happened, and again, with every tick higher, what I said before, I still maintain, the odds of new highs have gone up, increased substantially, actually, above that. That's what I said would happen. However, the odds before, when we were coming up here and I started scaling back in here, I would put the odds back then, I put it probably 80%. odds that we're going to take another leg down, take out the lows, and go to my next longer term targets. Again, if you're new, I'll just have to update these in different videos, or you can go back. We have long term swing targets down here. The next one, we've already hit 3. The next one's T4, 5, 6, and 7 down here, which I still maintain. So nothing has changed in that outlook, but yes, the real-time odds, the play-by-play, it's like betting on a football game before the game. You know, you have the line on the game, what the odds are, who's favored, and if the game is in the third quarter, you know, with a few minutes left on the clock, and the team that was not favored to win is down is ahead by 2 touchdowns, yeah, the odds at that point have changed. Now there's still a lot of time on the clock. You know, the game of football, 2 touchdowns is far from an insurmountable lead. So what I'm saying is real-time odds change, and so the odds change there. They've changed with each tick higher, but they went from, in my opinion, from all along before we even got to this level where I expected us to get, or it wouldn't have been the scale back in zone. The odds went down from 80% to, let's just say now, pick a number, 55, 60. They are still favorable. And again, I'll tell you why in the rest of this video. So, but favorable means anything above 50%. A coin toss is even odds. Favorable odds are anything above a 50% probability. So that probability is certainly shot down. Now, if we fail, as I suspect, remember, on the long-term calls, the targets I've given you now and have for a while are on the weekly time frame. So now it's going to take a hell of a reversal. And I don't think by the end of the week we're going to be back down below there. However, well, there you can see we just ticked red. If we start to come down in here, again, minute by minute, you know, in small percentage points, the odds change. They changed significantly for me. They'll start to spike back up closer to that, 60 plus, 70%. If we break the trend line, and especially if we fall back below the 200-day moving averages, because as I've mentioned many, many times, the 200-day moving averages are excellent trend indicators, especially in the tech-heavy indexes like the Nasdaq 100 and S&P 500, both of which tech's the largest components. They do an excellent job. I like on the weekly chart, plug them in as a 40-week period moving average. And it is not unusual. In fact, it's more than common, as I've addressed many times, to see intra-week pierces down below there, or even a week or two trading above, depending, again, which one you're talking about. Sometimes it's the simple, sometimes it's the exponential. So therefore, that's it. Really nothing else to add. Nothing's changed. Again, I will not add above the 200-day moving average or above this trend line. And I will only subtract. And of course, again, I start with the videos with the equity markets, cover that more than anything. But as I continually preach and harp on, in my opinion, it is one position. You can buy QQQ, you can buy SPY, and you own either 100 or 500 stocks within those ETFs. But it's one single position, one single trade. And, as you can see lately, we're just hitting them, picking them off elsewhere. Make money on natural gas as this is going up. Short natural gas, short the miners, go short treasuries, go long things, some things up, some things down. It's the whole premise of diversification. So just want to reiterate that this should be one trade, not all of somebody's portfolio. Unless that's your thing. If you only trade gold or you only trade QQQ or SPY, it's not my place to tell you what to do. I'm just telling you have a concentrated position, and you're either going to be very happy when you're right, or you're going to be very upset when you're wrong. All right, so that's it. So there we are. We'll see how the week finishes. We'll see how the candle looks. We start moving down this weekend or next. I will begin. If we do take out the trend line and the 200s, I will most likely be adding back any shorts that I've scaled out of. If they happen to get me, and we go up a little more and then reverse, even if I get, I'll have to reset at that point if the market continues up, because again, this is not where the market should have rallied to in optimal conditions. This was major resistance, as were the 200-day moving averages, and we're clearly above them right now. So that is it, in my opinion. Again, to reiterate, if I had $0, if I had just taken a 6-month vacation and come back, I wouldn't be going long or short right here. We're too overbought to go long, in my opinion. That's just not favorable, especially in bear markets, because the tag of the overbought level, which is 70 on the RSI, in bull markets, they're common, and you tend to stay more overbought. In bear markets, and you can go back in history or if you don't want to take my word on it, they're usually one and done. Again, bull markets, overbought tends to become more overbought and or stay overbought. Just exactly as in bull markets, oversold is usually fleeting and one and done. But in bear markets, which this is a trade of, it's very, very unusual. This is very much more typical of bear market action to be oversold, have a bounce back to the 50 level, and then become an even deeper oversold. Again, although the real-time odds have changed, ticked a little way, I still, at this point in time, clearly favor the another leg down, and just wanted to say there's a lot of technical evidence still pointing to that. There's just a little bit less than there was back here. Again, it's not optimal, and that's why I'm in that wait and see position instead of averaging down anymore on those short positions by adding to those. I will just wait. That's my preference. All right, guys. That's it. That's not much more to add other than that. You can look at SPY. SPY is a lot closer. SPY is also more representative of quote unquote the stock market. You have, again, much more broad coverage of different sectors, different industries, different stocks, 500 companies instead of 100. Yes, still overweighted in tech, but not nearly as heavy as the Nasdaq 100. And so there you are. We're close to that trend line, but above it, and also back into the trading range there. Okay, and just a quick update. There's a lot of indicators I follow. Again, some have a better track record than others, but I use these collectively together. And this is one of my favorites. It's what I call the money where your mouth is indicator, because there are various types of sentiment indicators. One of the most commonly cited is the AAII bull to bear spread, bull to bear ratio. It's a weekly survey and the respondents in rhetoric check a box: are they bullish or bearish? Do they expect stocks to go up or down? And there's a huge difference for somebody saying they're bullish or bearish versus actually putting their money where their mouth is, and that's the difference. That's why I call that one a rhetoric indicator and this one a money where your mouth is indicator, because you can say you are the most bullish person in the world, you're foaming in the mouth bullish, you think the market's going to go to the moon and back. However, one of two situations: you may either be fully committed. If you are, there's a good chance you are, and therefore you have no more money to put into the market, so that's not going to have any impact on the market. And that's what we see at highs. Bullishness reaches those extremes. And then the other is, I may say that I am bullish and plan to put all this money in the market, but then something changes my mind and I might not do it. And so therefore the CPC is people are laying bets. They're betting puts and calls in the market. A put is obviously a bearish bet or call and or hedge on the market, whereas a call is a bullish bet or a bet on the market. And so it has a much higher accuracy rate. Anything in the middle, I've always said, is absolute noise. Don't try to extrapolate or interpret any useful information. It's only good to at extremes. Any sentiment indicator is, in my opinion. Even the AAII, which I will use and have used, and we helped to identify that recent top pretty precisely with it. But this red zone this is where bear markets end. This is the financial crisis right here. I'm sorry, green's where you buy. I'm sorry, guys. Green spikes into the green zone up here, up top. Let me box tool it for you. Well, I'll circle it. I just have a circle tool selected. You can see the green zone right there shortly before and that's actually when the Nasdaq bottomed. Down below, I have the S&P 500. Most might not be aware. Almost every single index bottomed in March of 2009, yet the Nasdaq 100 and the majority of big tech stocks that rule the market, they bottomed in October. It was November, October, right there on that spike. And that said buy. And that meant everybody got bearish, and that was a good time to buy. And then you want to, after a bear market is over, and that was a 57% drop, you'll sit back for a while. Don't use these indicators. You want to use them to identify tops and bottoms after a prolonged bear market. You want to start looking for your it's signs of a bottom. And after a prolonged uptrend, you want to start looking for these drops into my red zone here. And that was it. That was several years later right there, and we had a 21% drop. And again, you can see here there was that big Q4 sideways drop, a year and a half of sideways with two big corrections, roughly 20% each one, and it was marked by that spike into the green zone. This was the great Q4 of 2018 drop. We milked that with impunity top to bottom, and that was also signaled at the end of it with that spike into my green zone. This was COVID, perfect kiss of my green zone from below. This was the 2022 bear market right there, which ended in October of 2022. Perfect spike there. That marked the end. And as you can see this time around, it wasn't even close. Let me repeat, it wasn't even close. There was no fear by my preferred indicator here. So that's just one thing that tells me whether this market wants to push around, test, punch through slightly new highs, or turn around next week and start a classic bear market next leg down, which catches all by surprise. The first big rally in a bear market, there's that return, they call it the return to normal phase, where you got a big leg down, everybody gets really bearish, you get the nice counter trend, big profitable bear market rally, and just when everything looks perfect and it looks like the worst is over and the market's going to new highs, that's when the bottom falls out. So we'll see. And again, this is there's not any one perfect indicator. I just want to say you can see it wasn't even close on this drop, and that drop broke many records on the way down. And so take it for what it's worth. So that's one. The other one that I talk about quite often, another indicator, and it's related to the CPC, if you will, is the VIX. The VIX is the methodology of the VIX. You can look it up. It's based on put and call buying on the S&P 500. And as I've covered many times in the past, this is you can go back long term on the VIX. Here we go. You know, over time, the way I study indicators, I never get married into one indicator working the same in every market condition. So when I look at the VIX, you know, this is where previous bear markets ended, or corrections back here, and the dot-com bubble included. And then we hit new record lows in the VIX, so things kind of different. This used to be the floor right there. This was a new floor, which has since been established, and you can see has been the floor. We were long with impunity off that bot drop there. We caught the last two ones, spikes as well, including this one, positioning long on the VIX, short on the market, and we were long there. And as you guys know, we just recently hit my T2, where it was advised, as I did, to book profits and even turn around and short it. I'll get to VIXY in a second. That was a preferred proxy. Before I do that, the takeaway is, so this was the financial crisis right here, which was from October of 2007 to March of 09. Again, a roughly 57% drop in both the S&P 500 and Nasdaq 100. It was a rare instance where the S&P dropped as much as the Nasdaq because of the problems in the banking sector. Remember, the Nasdaq 100 has very little to no weighting in financials. It's mostly heavy in tech. It has other sectors, biotech and all that, but little, if any, financials, which the S&P, especially back then, had a lot of. So that's why the S&P went down on par with the Nasdaq. Next time around, I suspect it'll be well, I don't know. We'll get to that later. When the financial system, at some point in the bear market, if and when I'm right on this call now, and it's where it's underway, it'll probably be later this year. You'll start seeing cracks happening in the financial system, would be my guess. But we're not even halfway through the year, so it's still possible. Again, we'll get to that at the time. Right now, I think the best RR is on the tech sector for the short side. Okay, so that was, and again, the VIX trades very well to technicals. Again, we've had some phenomenal trades on there. If you've caught even part of any of the VIX trades we've done the last few in the last year, we've had three nice spikes in the VIX. Again, we were positioned long each one, and also got out in time. That's the most important thing. You got to be Johnny on the spot when you are a short seller, and a short seller is basically to be, buy the VIX is basically a bet on shorting the market. And you can see big divergent lows, and that's where I like to go long and the VIX and short the markets, and we've had these two big spikes. But the takeaway here, guys, is, as I've talked about, since in modern decades, I should say, going back to the financial crisis, That's where, and that is that, and by some consider COVID a real bear market. It was a 36% drop in the S&P, but it happened quick. Either way, you can see this is where those two officially were both bear markets, right? And that's where bear markets end. Since then, we've had a lot of nice, healthy corrections. That's as swing traders. That's what we do. So if you're wondering, because sometimes I get these, especially lately, how can you be bearish in a bull market? How can you be? Again, I swing trade. If you want, listen to John Bogle, the late great John Bogle. If you have a 10-year time horizon, you want to always be bullish, 10 plus year, put all your money in an index fund and don't waste your time doing this. If that's, if you believe stocks will go up forever, and they do over time, they will go up. But swing traders, this is what we do. We game the ups and downs, the rips and dips. And bear markets are phenomenally profitable to trade. If you haven't seen that this year, we were short at the highs, we covered at the lows, we gamed the first bounce to the 200s in between there, and gamed the bulk of this rally, at least half of this rally, I should say, up, and then started positioning for the next leg down. And so even win or lose, if this trade for me is stopped out, I've outperformed the stock market just on the stock market trades by a multiple of many times, and so that's where we're at now. So I want to just point out again, this is where corrections end right here, and we did. So I will give it that. If this all this was this drop, again, it didn't have to do with the tariffs. The market was, let's not forget, the market was already halfway down. We already had swing short positions. We added to those on Liberation Day. Was that all in? That's when I said we'd get the lights out drop in the market. Before that was right when Trump stepped up to the podium that day, and then we had the second half of that big drop down from that point. So the charts were already saying at that point, get long the VIX again here. And so that's my point here. Was it a correction on the road to new highs? Quite possibly. If it is a bear market, again, each bear market's different. Back in 06, 07, we were coming off record low volatility. And so right here in October of 2007 was when the market peaked, and we had our first big drop. Somewhere in there, the first big drop, and there was a spike in the VIX. You had a counter trend rally, and then the VIX dropped down, but it had one additional surge up. So you had these two little, if you will, pops here in the VIX. Everybody thought, and then there was a bear market rally, the first one, and everybody thought it was safe to come back, get back in the water, and then boom, the next big leg down came. So we'll see if that's going to happen this time or not. All I can tell you, if it is a bear market, and again, guys, only time will tell. If it'll go down in history. The Nasdaq technically hit bear market territory. I think that the S&P did it too. It's semantics to me. I think the S&P was down from high to low, at least intraday, if not closing basis, 20%. So I'm not talking 20%. To me is not a bear market anymore, with all the manipulation and excessive intervention by the Fed and the central, and the federal government into the markets. Volatility is a lot higher than it used to be. 20% corrections happen almost every year now. So we'll see. All right, so I just want to point that out. That's where we're at. Let's not spend any more time on it. It's a pretty darn reliable indicator. And now let's since you can't buy or sell the VIX directly, nobody can. It's a index that you can only trade indirectly via derivatives. Those derivatives being futures on the VIX, options on those futures, or the ETFs and ETNs such as VIXY that then trade the futures. Me personally, I trade the futures. They're a pure play. I don't have to deal with these guys have expenses and fees, and they will underperform. But that's neither here nor there. I know a lot don't have a futures account. So this it literally couldn't have been traded so far with any more precision. Again, we were low off the lows there. We took add on the bullish falling wedge breakout. That was the final target given to you back in July. Remember, we were covering all shorts, posted the morning of August 5th lows. Hard reversal, cover all shorts, go to full long position. That was exactly that day right there. And we were long back here as well. We hit the first target, got the expected pullback, gave you before we even got there, scale back in zone. We hit the bottom of it. Then we hit T2, same things. The odds for reversal are high. Also mentioned on the day of the market bottom, April 7th or whatever. I posted that recently, went over it in a video, that I am fully long. All shorts have been covered. The risk reward is to the upside, and I'll adjust if needed. And that was also short the VIX, and you can see we went down. But unlike that time, or similar to that time, I had a range, but it was a wider range. And again, just like the market, so it's the same story. No, in my opinion, though, in hindsight, the range maybe should have been a little bit wider, because this is price support. Remember, this was back then, S2. I haven't moved this line. That line was created back on January 30th of this year, long before the whole thing happened. And that was price support. Very good price support. If you see through here, look at all these reactions from above and below. And we just hit that and bounced off it, right? We also hit the 200-day moving average and bounced off it. Remember, the VIX is almost like the stock market in reverse. And we're back to today. We just punched through. We've been flirting with the bottomized zone. So we went a hair below it. Same story, guys, with the equity markets. To me, this is the kind of the no-go level. But if we get the reversal, which I still favor, and let's say next week the uptrend lines in the equity markets are broken, that should mean that the downtrend line, the VIX, gets broken. We're back at the bottom of the scale back in zone. Again, start covering shorts here and start scaling back in long here for a long-term swing trade with profit potential if my third and final target is hit, which again, remember, this T3 was given back here when we went long, even before the breakout there, right off the lows. That'd be 168% rally. And from where we're at now, again, if you take all the long here, exit there, short, re-enter here, long, turn around, close longs, short, start going back long, you're talking a multiple at probably 300+% on your money on just trading the VIX right there. So if that is hit now, meaning in the coming weeks, probably wouldn't be much more than a few months, about 120% return from where we're at now. But however, it's a no-go right now. So you can also see it's a no-go for the reasons I just mentioned. If you can't make an objective case to short the equity markets, in my opinion, you cannot make an objective case to go long the VIX. It's that simple. But there's this uptrend line I just gave you right here. I wanted to point that out for you. And you can see it also on the 60-minute chart right there. So there's an uptrend line. We had a divergent low and a breakout. That it didn't pan out for a rally. I highlighted at the time. Again, it was an objective entry, but it didn't pan out. However, if you're trading, what I call playing the long game, then, as I said, you'd be trading off this chart and the weekly chart of the indexes, SPY and QQQ. And there we are at that trend line. So we'll see what happens next week. Today's almost over. Let me get to the rest of the stuff. Again, closely related is SOXX. The SOXX semiconductor trade. Majority of these updates were covered in videos. When I give you the charts, I'll say most recent screenshot chart. I had a couple different boards here all along throughout here. Remember, we had a bearish rising wedge, big divergent high. Semis moved down. I had a total of 6 targets I gave you. T6 was, every time I change it, I have to update it. It was originally created back on August of 2024. And we hit that with impunity to the button. We didn't have a T7 there. We didn't have a T8. And it was also the long-term uptrend line, as I've covered I covered the semis in detail recently. So not many out there that can call it down to near perfection, a 45% drop in the semi sector. Turn around again, everything, all longs on August or April, whatever the recent lows were, a little over a month ago, about April 7th, whatever it was. And as highlighted, the semis have bounced back. So what this is, what I'm looking at here, and again, they were covered in detail before. You can look at the SOXX semiconductor sector, which is really what that ETF tracks. And there's our long-term chart right here. I have a couple different boards. Where are they? But by most metrics, especially we'll go back to SOXX. There it is. By most metrics, or by my analysis, I should say, this was a huge divergent high, much bigger than these previous divergent highs, which resulted in this is a big secular bull market right here, this trend line off the 2009 lows. And so these are swing trades within short counter trend trades within a secular bull market that were all well into the double digits, as much as 48%, 45 on that most recent drop. Again, that was to the final sixth and final target. But the divergence is much larger than any divergence we've seen. And that tells me that this uptrend, this bull trend in the semis, like all trends in history, will end. There's no trend that doesn't come to an end in the financial markets. You have your larger secular trends, and then you have your smaller, what we call cyclical trends. So this is a secular bull with cyclical bear markets within there. That was certainly, well, the time will tell. Was it only a cyclical bear market, I'm sorry, with the semis to go on and continue and go to new highs and keep going up this uptrend line longer term in the years to come, or will it break? I suspect it will break, and therefore I will most likely be adding much more aggressive longer term targets. But I did throw it out as a short trade, and I still maintain it's one of my favorites right now. I am not scaling out of this one. In fact, I only just took it last week or this week, whenever I threw that out to you guys. Right here, you can see on the daily chart, we had big price resistance. This was a big level to me. It defined this whole shelf of support right here before the semis really let loose. And we just recently rallied up to that. Remember, I make a lot of terms up. One of the terms that I use that I've made up is I call it momentum fueled overshoots. When you have a near vertical drop or a near vertical rally, it is more than common. In other words, more than 50% chance you're going to overshoot any resistance level or support level on the way down. If you look closely, there was a slight spike through there and through the 200s right there. You spiked through the 200s, spiked through them again. Then we were trading off when we lost them here, and we were back testing from above. So it's more than common to overshoot. So I highlighted this, the precise entry was right there, I believe, at the 200-day move. And we're right there still. I've turned off all the lines. We had price resistance and the 200s. So far, the semis have rallied back. This is the first true test. If you zoom out, forget about this daily chart when you see the slicing through. That's just volatility. You go to a bigger picture, you look at a weekly chart, it helps to smooth out. Or you can turn on a line chart, turn off the candles because they're showing you the intraday moves, where the line charts only reflect end-of-day closes. And so bigger picture is, this is the SOXX. It clearly lost the 200s here after flirting with them for a while. And this is the first back test. This is simple TA 101. And again, guys, I know that some of you may be the silent majority out there. This is how I see things. And look, in 3 weeks or 4 weeks from now, if we're up here, guess what just happened? It's harder for me to make that bearish case. This is one more check mark for the bulls if we get up here and we clearly start on a weekly basis moving away. Not 1 week like right here, 1 week above or below. Clearly start moving away, and that's not the case. And this is what I call the canary in the coal mine for the tech sector, the semiconductors. They certainly peaked long before this, not long before. They peaked back in July of, you can see there, the week of July 12th, 2024. The Nasdaq 100 peaked a little bit later in, I think it was October, November of 2024. Or no, it was more recently. And so these will often turn in advance and then big tech fall. Why is that? Think about it. If the semiconductor companies start seeing a slowdown in orders, you're hearing, on cheerleading on CNBC, the AI bubble still, the AI trade's still there, and Google and Alphabet are going to spend. But in reality, if they're cutting back orders on semiconductor chips, then that doesn't bode well for the tech sector as a whole. It's, again, in my opinion, it's always been a pretty accurate predictor of things to come. Again, I call it the canary in the coal mine for the tech sector. And the tech sector is everything in the stock market nowadays due to the simple weighting of the big tech companies. That's it, guys. So that's it. It's a bear market rally. It's a nice one. I hope some you caught some or all of it. It's been 47%. I wish I could say I milked all of it, but I don't. I don't always try to milk every bit of a run. That's why sometimes I am precise on. I was certainly precise on exits there, and then there are times where just my clarity of where a current trend is going to end. And that's why I've had the ranges, those box ranges on the indexes, and I watch these key sectors. If this was some obscure sector that didn't have a big weighting and it didn't matter elsewhere, it wouldn't be germane to the conversation in the stock markets. But this is the most important subsector of the largest sector, and again, both the S&P 500 and the Nasdaq 100, which is technology. Tech is about half of that Nasdaq 100, and it's over a quarter of the S&P 500. And so this, within tech, you have your subsectors. You have software, semiconductors, and things like that. So there it is, guys. And on that, to just take it one step further, if you're not semied out yet, is NVIDIA. Again, our calls on the video, at least my trades personal last few years, the stock has put a lot of money in my pocket, long and short, and it's now up there. As I mentioned the other day, I still very much like this one. Again, so I started a new swing trend short in this. I shared it on the site. You can take it, not take it's up to you. This is where we hit T2 right here. We went a little down through it. Remember, this is the week of August, April 7th. That's when I started, getting shifting from bearish to bullish, and that's when it bottomed. So to expect it to go on to hit T2, and at that point I said no more longs. No more shorts, only longs. And I even gave you the arrow. When we hit, I gave you the arrow. I just posted this the other day. When we hit T1, that was it. Said before we go to T2, we're going to have a counter trend bounce and go down. That's how the arrows were. That's taken us right back to where we were. Again, a little high. So on this one, the same kind of mindset that I have, and I'm speaking generic. If I had no positions right now, maybe hold off to see the equity markets drop back down below those levels. Let NVIDIA drop back down below the 200s, and then this will prove to be nothing more than a short-lived break above. Just like back here, NVIDIA, you can see, closed that week on the 200-day exponential, or 40-week, same thing. Took it out intra-week the next week right there, only to reverse, recovered, kept above there. Right here, this was solid. This right there, when I say a solid weekly close, that's what that was. And then once that was established, this was an intra-week plunge only to close back above. Then rejection, 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 and then now recovery. And again, sometimes it's the simple, sometimes it's the exponential. Right now, we're above it. If tomorrow is a shitty day in the market, then NVIDIA could close back down or below. Even if it closes a little bit above, again, it's the nature of these volatile companies. But as I said, each week, if next week, again, and this is all collectively I'm speaking, NVIDIA, and just imagine this is a candle. If I didn't grab my box tool, we have another big green candle. You start moving up, and it gets hard. It gets hard to make the bearish case. And at that point, I will acknowledge you're going to have another divergent high. It's probably just going to set the stage for an even bigger drop down the road. But you might not want to ride that out short, because who's to say if it's marginal, how marginal? And then, even then, divergences, although very often, much more often than not, big divergent highs like this are accompanied by a major trend reversal. Sometimes they're not. Even if that sometimes is only 10 or 20%, you can't afford to wait till the divergences are burned out. So that's why, like I said, we're kind of in the let's wait and see this week, next. My mindset is kind of I'm on pause, if you will, for adding new shorts, but I'm comfortable with what I had now. At this very point in time, as I speak to you, I'm more concerned on the index shorts, whether I continue to reduce and take those out. But I'm kind of liking and positioning back in, if you haven't seen it lately, I'm more on individual stocks and sectors. It's been a broad-based rally, so you can be in just QQQ and you don't have to waste your mental energy on picking individual stocks. However, on the way down, I think it makes sense. I think some are going to turn before others, and I also think some will outperform. If I'm right on NVIDIA, and we've certainly been right so far, remember T1 was laid out right here last year, but we've covered these, back there. We covered on the August 5th lows right there with perfection at the low there, reversed everything, went long, and it was also T1. Here was highlighted again, expected bounce, and we were covering shorts, no more shorts, only longs here. And so this is just, it's taking a while, but this is a long-term swing / trend trade. And if my final target is hit, that means NVIDIA is going to fall another 70% from where we are. And I've said this bears repeating to those that are new to the site or my analysis. I know my calls might seem grandiose to some out there. I am not a showboater. I trade for a living. That's where my primary source of income is, not from the revenue on this website. And as I've showed you, this is the nature of the beast. Some people just don't take the time to look at charts. By the way, these are 90% bear market drops off the divergent high, 86, 56, 69. They're simply secular bull market corrections. And if you want to call them cyclical bear markets within, you could call them whatever you want. But when you look at the chart, that's all it is. Those are just corrections. So I personally, you want the truth, and that's why you see these right here. This says potential T5, potential T6. I think there is the potential for even larger drops. I could only tell you if and when we get near T4, if that's going to be the final target, or at least where I'll be covering and reversing. And there's a good chance I'll be covering and reversing, as I often do on T2. I don't, I'll always game these long-term trades personally because I am an active trader. I'll game the squiggles, what I call the squiggles, or the counter trend moves on the way down. All right, so there it is. And again, this is the king of the semiconductor sector ETF. So to be short NVIDIA is to be short SOXX. And there's also the index, the inverse ones. If you want them, try to stay away from leverage unless you think there's going to be a pretty straight drop. Like I've told you recently, my preference on the accounts that I'm not using the NQ futures on, or RTY. Oh yeah, let me get to RTY for you. That PSQ I think is a better way to go. It's a non-leveraged short on the Nasdaq 100, or you can just short QQQ, of course, if you have that. But let me show you IWM, the small caps, real quick. Kind of big picture here. And again, might not get to some of the other stuff I talked about earlier because I forgot. I've been wanting to cover this. This is a potential double top pattern. It's the purple box I have here. I can do this. It doesn't take me too long. Change it to a frame tool. This right here, that's the potential double top. You have a high there by a reversal. You have several lows there. A double top pattern, you can look these up. You take the measure, to get the measure target, you take the width of the pattern, again, this is the base of it, and you add that to where it breaks down. So that's my minimum long-term target right there. Now, the pattern the trigger is a breakdown below the pattern. If that happens, it's also going to coincide with this primary uptrend line off the 2009 lows. So again, this is your secular bull market uptrend line. This is your potential. Again, it's only a potential double top pattern pending a breakdown, but if it happens, it's also going to take out that trend line. And from where we're at today, that would give you a drop in the small caps of about 50%. Well in line with a bear market in the small caps, all right? That's and actually, it'd be a little more if you measure from the recent highs. So now, where we're at today, again, that's long-term stuff. Nobody's going to position for a breakdown that hasn't happened yet. Some might in anticipation of it, but zooming down to the shorter term, you can see we're currently backtesting the 40-week exponential moving average. Remember, these are trend indicators. In a bull market, you want to buy pullbacks to the 200s, and then when they break, you want to be short, and that's it. And then you want to short rallies back to them. That's it. That's how it works. Here was a bull market. 200s were holding support. 200s got lost right here. Short rallies back to them. Short rallies back to them. Stop shorting the rallies back to them when it gets taken, or stay away if you're chopping through them. Some things, some sectors, some stocks, some indexes will go into a trading range. Learn to recognize if you're in a sideways trading range, you're going through them, you're going to get whipped to death. You want to use these moving averages as trend in a trending market. In a bearish or bullish trend. So right now there's a bearish trend clearly, right? And we've rallied back to the 200 simple. If we go higher, there's the 200. I'm sorry, this is the 40-week simple exponential moving average. There's the 40-week simple a little bit above it. And you go to the daily chart, you can see there it is, the 200-day simple. And you can see right here, they were buying the 200s. 200s are lost. If you shorted the clear breakdown of the 200s then, you made 21%. If you started covering, as was advised around the April 6 lows, covering those shorts, you booked profits, you didn't get back, and then you gamed it long, and you would have been scaling. And right now, this is the first time I've highlighted small caps for you as an objective short entry in a while. Beautiful downtrend line off the highs. Let me turn off all the levels and just redraw it for you. Again, you have a downtrend line off the highs. You have a clearly bearish trend so far. It's taken out that previous reaction high. It would be it would be ideal to see it rejected here. Sure, we can go up there to the 200, but again, same story. I wouldn't add above here. You can take a shot here. I would sit tight. I wouldn't stop out right away. I would stop out somewhere if we start to move above the 200, because then you're also going to have, you can see here, you have some nice price resistance that comes right in with the 200-day simple moving average. Or you can wait for a break of that. Again, same beautiful uptrend line, well-defined. All these indexes are walking up right now. IWM's a lot closer. If you're a futures trader, RTY is your poison, or if you're new to futures, you have a smaller account size, M2K is the mini version of this. It trades off the same exact price levels, so you can replicate this chart. It just has a smaller multiplier, meaning a smaller leverage factor. And again, that's M as in Mary, 2, the number 2, and then K as in kilo. There's your downtrend line right there. There was a divergent low. All the reasons in the world cited back then to stop shorting, and no more shorts, only longs. Rally back up, bear market rally at resistance. You can short it here with a tight stop right above, or you can use that alternative stop that I mentioned on IWM, a little bit higher, price resistance, 200-day simple moving average a little bit above. Again, it depends on what you're targeting. Or maybe you think the market, including the small caps, are going to new highs, but so we differ there. However, you're in agreement that, hey, we're way overbought. We got to at least have a correction. Again, the analysis I provide can be used many different ways. So there's an uptrend line in which to trigger a sell signal. It's the same one I just gave you on IWM daily chart. That would trigger a sell signal. I haven't updated this chart in a while, but you see at least down to about right here, minimum 1998. And or down here, maybe all the way down to about 1900 if you think we're going to new highs, or if you're playing, again, the long game, meaning going for that big drop, next leg down to bear market, you can have your stops up here, and your RR is phenomenal. You're only risking a few percentage points to make high or well into the double digits on the drop, which isn't even on this chart. It's much lower. You got to go out to my weekly charts then. I just showed you where the longer term targets were, because then we'd go on to take out the bottom of that double top basing pattern and move on down. All right, before I wrap up, I think natural gas just hit the third target. Let me jump over to, yeah, there it is. So I give you one thing I do here, not just give you trade setups, objective entries, where they provide an objective entry, where they provide an objective exit. I do my best to update trades and give you my thoughts and tell you, as I did here when we were at T1. I said I don't favor reaction like I normally do. I think we'll go on down to T2 before the next reaction. That's exactly what happened, right? We went down there, so that would have kept you not only short but also not losing any money trying to game a bounce. It never came. Now, we did have a reaction. I define a reaction as one of two things. I call it the hacky sack or the golf ball reaction. You drop a hacky sack and a golf ball on both on a concrete floor. The hacky sack's going to sit and go flop and not bounce. It's going to stop there, whereas the golf ball will bounce and then come back down. So that's a reaction in time. That's the weaker of the two. So we did have a reaction, and then we went on down. Now we've hit T3. And we're also back testing the trend line. So good place, in my opinion, to cover that. And official, not official, doesn't matter. You have my thoughts. I think it's a good time to close book full profits on the trade. That's what I've done here. So there's an uptrend line. I'm not going to go long right now. I don't have enough evidence in the charts. If I change that, it's not T4 that was hit. It was T3. I think you guys know what I meant. So I know my posts are full of typos. I don't proof them. Sometimes you guys will correct me on something or ask for clarification. Numbers are wrong, but and sometimes I'll misspeak in these videos, but I just caught that one. So T3's hit. I'll leave it on for now, but you guys decide what you want to do. That's a perfect tag of the third target. Nothing big, but but also another term I make up is velocity. This trade's been less than a week, a few days, 8%. You make 8% in swing trading, 8% a week. If you do that just one trade a month, you sit, wait, because you can't do it day in, day out. What is that annualized? You're talking well north of 100%. Not even annualized, just simple, non-compounded returns would be over 96%, right? But all right, let me move on here. Now we're at the 57-minute mark. I gave you the update. GDX hit T2 today. If you want, in the comments section, I caught up to the last couple posts. Somebody asked about the gold miners, PAAS, and I think it was AEM. I posted those charts and my thoughts. I don't have strong convictions on the miners. I think that T2 was a good level to cover on GDX today. We did bounce off there. I just want to say that my convictions are not as strong on gold at this point in time. Whether that's it, we milked whatever it was, 10% or so off the last leg down on GDX. So take it for what it's worth. And I'm going to wrap the video here because I just looked up and the counter's at 51 minutes. For those of you new to the site, remember down on the bottom right corner when you watch a YouTube video, including whether you watch it on the website on rightsideofthechart.com or you click the open in YouTube, the settings are down on the bottom right. And you have that little icon. You can increase playback speed to whatever you want, up to 2 times. So 1.5, 1.25, and that just gets you through these videos. You can whip through a 50-minute video in probably, half an hour if you want, or skip ahead. That's why I try to identify in the order I'm going to cover things before I do it. But I'm going to stop it here. Got enough out for you. My thoughts, the levels to watch. And as always, if you have any questions, I had a lot of things going on yesterday, so I might not get back to all the questions. I didn't get to those questions. I didn't even open that comment thread. Please post it under this one if I missed any chart request or anything else. This has been Randy Finney with Right Side of the Chart. Have a great day.